Last week was another big one for the markets. Got some dovish comments from the Fed, and it looks like we're on the cusp of an unwinding of a historic rate hike cycle that has now, on the cusp of anyway, come to an end. So comments were, again, very dovish and favorable that rate cuts are pretty much imminent. It looks like probably in September. So let's get into the numbers behind what occurred last week. So as you can see here, all the major indices up pretty nicely. Get the little laser pointer out here. One real standout again is small cap, and we've talked about this. I've probably exhausted you with it, but small caps really need a good economic environment. And frankly, rates are one of the primary drivers of that, just in general, but particularly for small caps, as they don't have access to the credit markets quite like the large caps do. Have floating rate loans, things like that, where they're much more susceptible to a rising rate and a high rate environment. So you've really seen small caps screaming higher over the last couple of weeks, and whether or not this continues, who knows, but it's nice to see them finally coming out of the doldrums, so to speak. So switching gears to just year-to-date performance across the board, again, very, very strong. The broad market's up almost 20% on the year. Nasdaq is right there. Tech has really rebounded since that sell-off a few weeks ago, as rates have now come down in expectation of further rate cuts. So it's just been a stellar environment, frankly. I would expect a little, back and forth here, volatility, given the fact that this has been kind of a historic rate hike cycle, and now coming off of that, it's likely that it's going to be a little back and forth for a while, a little violent in terms of volatility. That is probably to be expected, so I wouldn't be too concerned about that, particularly as we head into November, which is an election cycle, very contentious, obviously. So a lot of things going on, but all in all, it is a very, very good environment for stocks. Everything is pointing up. The economic picture, although it's slowed, is indicating more of a soft landing. And as rates come down, I think it's a prime environment for stocks. So we shall see, but that's the way it looks. Rates again continue to come down. Again, the Fed hasn't done anything in terms of lowering rates, but as you can see, they don't control everything. Obviously, the rate, the market's going to do what the market does, and rates have continued to come down. So now you're seeing that 10-year well below 4%, 2 years at just right around 4%, but 30-year mortgage continues to come down. We're at 6.96. At one point, it had gotten down to close to 6.5, kind of intraday, a week or so ago. But nice to see that coming down, and hopefully that'll be a little shot of adrenaline in the housing market, particularly for those of you who are looking to buy a first-time home. I know it's been really tough, so hopefully that'll help. Again, dovish week across the board, very favorable comments. Stock started the week strong, rallying after Wall Street welcomed dovish comments from Minneapolis Fed Kashkari, and the S&P 500 and Nasdaq each posted gains on Monday. This was the 8th consecutive winning session, and the Dow rose for the 5th session in a row. And then from there, we had markets trading in kind of a narrow band until Wednesday afternoon, when we had the minutes released from the FOMC meeting. And of course, that revealed dovish comments. So on Thursday, stocks slipped ahead of Fed Chair Powell's annual Jackson Hole, Wyoming speech. Kind of all eyes and ears were on the Fed, but the comments were very well received from Powell on Friday, and that boosted the markets, and all three averages were considerably higher. So ended up being a very, very nice week for stocks. Again, basically the comments from Powell were that the time has come for kind of an adapting policy stance. So they're ready, barring some unforeseen kind of disaster. I think it's probably inevitable that we shall see rate cuts in September. The Fed's annual symposium for global central bankers started Friday morning with Fed Chair Powell's much anticipated speech and citing the risk of the labor market cooling even further. He said, the time has come for policy to adjust. So there you have it. Investors responded favorably, with the remaining question being how significant a rate cut might be. Powell kept that door open, adding that the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. So now it's almost like the conversation has shifted from, will they to, how much? Is it a quarter point, 0.5%? I don't think it matters all that much. To me, it's just more about consistency and transparency of, the cuts and much more so probably than the degree. Obviously, you would like to see a bigger cut. That would be great, I think. But, they don't want to move too fast, too soon. So what's on deck this week? We've got some key economic data, of course. Monday, today, is durable goods. Tuesday's the consumer confidence and the Case-Shiller home price index. Wednesday, we have Raphael Bostic speaking. He's a Fed official. And Thursday, GDP, international trade in goods, jobless claims. That'll be a big one. And pending home sales, another big one. Friday, personal income and outlays and consumer sentiment. Not a huge week for earnings in terms of the volume, but check out Wednesday. This is NVIDIA. This is probably the only one that matters this week. There's a lot of analysts kind of hanging on every data point here for NVIDIA, but the bottom line is, I don't want to say it's a must have earnings report, but just in terms of the market's reaction and kind of a favorable outcome here, it seems to have a lot riding on NVIDIA's earnings reports, at least being in line with expectations, and there's a lot of anticipation that they'll be better than expectations. Again, these quarterly earnings reports don't matter really a hill of beans in the long term in terms of long-term performance of a stock or the S&P. Earnings matter, absolutely. They're critical. But these, every 3 months, earnings reports don't have a tendency to move markets long-term. It's just more about the state of where we are and, the market's reaction to kind of that current state. And so NVIDIA is obviously a major player in this whole artificial intelligence boom. And so all eyes are on NVIDIA to kind of keep that momentum going and kind of keep the steam going in this bull market. So it's a big one in terms of just momentum and confidence, I think, in the market. But again, earnings reports every 3 months, they don't really matter in the long term. It's the earnings themselves, but not these little snippets of reports every 3 months. So obviously, we'll be keeping an eye on it, and hopefully it's a good report. As always, folks, this is our contact information. If you'd like to get in touch with us for any reason, we'd love to speak with you, whether you're a client or a prospect, maybe needing some help. Hit that subscribe button down below. Get all our videos as they come out. We'd love to have you as a subscriber. And here's a little disclosures for you. And other than that, folks, we'll report back to you next week. Hopefully it's a good one. Thanks, guys. Have a good Monday.